Let's screen the Slido results. I think it's already up there. All right. The answer to the question, Slido question is the lease percent. 25 to 35% is the correct answer, and most of you have got it right. I put it pre-pandemic because the lease finance dipped slightly below 25% last year. But again, yeah, all of you got it right. With the rising cost of new vehicles and general rate environment, lease is a growing option for financing new vehicles. So also, Melinda also gave it away in one of her slides if you have caught that. Okay, for our next session on auto purchases and residual valuations, I invite Rick Murphy to moderate the panel. Rick is a senior bank examiner with the Federal Reserve Bank of Richmond. Murphy is currently responsible for monitoring retail credit risk at a large retail firm and is also co-leading the system-wide Large Institution Supervision Coordination Committee. It's a big acronym, LISIC. He's responsible for monitoring retail auto credit and strategy trends. Rick, it's all yours.
Thank you. Well, I've got the pleasure of introducing our speakers today. Our speaker, well, I found quite an interesting paper. It was one of the, if you will, urban legends of the business. Yichen Su joined the research department of the Federal Reserve in Dallas in 2018. His current research focuses on urban economics, labor economics, and public economics. His doctoral dissertation investigates urban gentrification, and he's also done some excellent work on gender wage gap. With that, I will pass it over to Yichen.
All right. Okay, so you can see the slides, right? Okay. Thank you so much for including me in the program. I'm very excited. Before I start, I should emphasize that this is a piece of academic research work conducted by me and my colleague Wenhua, and this is still evolving, so any feedback would be really, really useful. And the view expressed here are ours only and does not necessarily represent that of the Federal Reserve. In addition, we changed the word here, credit-constrained consumers, to non-prime consumers, which we think is more appropriate. So let me begin. Okay, so it is widely known that consumers with higher income or wealth often spend more on luxury goods. And as a result of this common knowledge, owning luxury goods that are visible to others could often signal people's income and wealth status. And if consumers with lower income find satisfaction of being perceived as, being in higher status, they may be motivated to purchase luxury goods. Alternatively, lower income consumers may also be motivated to emulate their wealthier peers' visible luxury goods so that they can, quote unquote, keep up with the Joneses. And these motivations could lead to consumers purchasing more conspicuous luxury goods than what these goods' inherent functionality warrants. And the large spending on conspicuous goods made by low-income consumers could sometimes be concerning because more spending on conspicuous consumption often implies cutting back on inconspicuous necessity goods, reducing savings, or accumulating additional debts, which could be financially costly. So in our paper, we try to study the extent to which the pursuit of prestige and conspicuous consumption affects the automobile vehicle purchases by non-prime consumers. And vehicle is a sort of a special case because it's a highly visible commodity that is prone to conspicuous consumption. It is often among the largest items purchased by a typical consumer, and in the United States, they're often financed by loans. In other words, spending beyond the means driven by conspicuous consumption motives could have adverse financial impact on consumers, particularly non-prime consumers, categorized often as those with credit scores that are lower than 660. And so our paper basically tried to study how much the demand for prestige would increase the number of purchases of expensive vehicles by non-prime consumers. And of course, how do we know that, that the demand for prestige is necessarily driven by conspicuous consumption motives, right? So prestigious vehicles often carry good qualities valued by consumers that are unobserved by researchers. So to test that empirically, we break down conspicuous consumption into two types, right? One is status signaling, the other one is peer emulation. And we use some simple theories to derive a few testable predictions, which we could then take to the data. And with the data, we show that the demand for prestige does seem to be driven by conspicuous consumption motives. And finally, we ask ourselves, so what? Non-prime consumers like to buy prestigious vehicles. Of course, people should buy whatever they want to buy, right? But we do show that large spending on vehicles financed by auto loans leads to adverse financial consequences, particularly for non-prime consumers, for non-prime borrowers, in terms of loan performance and future credit scores. So that's basically, what this paper is about. So what data do we use? The main data we use is the auto count data provided by the Experian monthly report on auto loan underwritings. The data set allows us to see the precise number of purchases made by consumers from each zip code, living in each zip code, in each credit score range for each precise model of vehicles. So basically, within each cell, we know how many purchases are made. And we also know the brand and the make the model belongs to, the segment of the model, and whether the model is new or used. And we use the polled data from 2015 to 2019. So this gives us an extremely detailed information on both the consumers and the type of vehicles that they buy. And we use this data to really estimate non-prime consumers' demand for prestige and test for conspicuous consumption motives, which we'll describe later. We also use the New York Fed Consumer Credit Panel to study the financial consequences of obtaining large auto loans on non-prime consumers. So that data provides monthly financial outcomes such as account balances, delinquency status, and credit scores at trade line and borrower level. So using that, we can track the performance for each loan from its initiation. And we'll also describe that later, what we do with it. To give you an idea of what's in the auto count data, here is the summary statistic of the percentage of vehicles in each price range that are purchased by prime consumers versus non-prime consumers. We assign the price of vehicles based on the average value of each vehicle models and the new and used status of vehicles sold. We use the national data, and you can see that for vehicles that are under $20,000, they're mostly purchased by non-prime consumers, but more expensive vehicles are primarily bought by prime consumers. However, we do want to point out that non-prime consumers buy a considerable share of expensive vehicles, around 20% of the vehicles above $35,000. And the data allows us to match the vehicle models to a brand or make. This is just to give you a sense of what we can see in the data. So I'm plotting the national market share of the brands cut by the buyer's prime status. So this is pretty intuitive, the ranking. And then here I'm plotting an example of model market share. So basically, we can see very detailed models. In the analysis, we'll drill down to more geographically local level to study vehicle demand at county, at zip code level, and look at how people are different in terms of their price sensitivity and their demand in vehicle prestige across prime status and across neighborhoods. So that's the data. So now let me talk about our empirical analysis. So for econometric reasons, we cannot, I'm not going to talk too much about. We can only identify each consumer group's preference for prestige relative to the average consumers. We cannot do it on an absolute level. So we use this regression model to estimate how much more sensitive non-prime consumers are to vehicle prices compared to the average consumer, and whether non-prime consumers have a stronger demand for prestige compared to the average consumer. And so the colored coefficient is really what we're after. So this C term is really the luxury content of the vehicle, and we measure the vehicle prestige by calculating a luxury content of the brand that the vehicle belongs to. So we calculate the luxury content of each brand by computing the share of new vehicles sold within a brand that can be categorized as luxury, and we derive luxury in a variety of ways, mainly by segment and by vehicle value. So without further ado, let's just show you the regression results. So I know there are too many numbers, but I will tell you what we found verbally so that anyone can understand. So if you focus on column 1, we find, not surprisingly, that non-prime consumers are more sensitive to vehicle price than average consumer. But very interestingly and somewhat unexpectedly, holding vehicle price constant, we find that non-prime consumers have a stronger demand for brand luxury share, which is our measurement of vehicle prestige. And this result is really robust when we vary the definition of brand luxury share. And it's also very robust if we look at location by location. So it's a really robust result. So what this means is that, if you look at two very, very similar vehicles, the non-prime consumers really compared to the average consumers, they're more likely to buy the luxury, the one with more with a sort of higher brand luxury share, or they're more willing to pay for the brand luxury share. So on average, we know that we know that prime consumers generally buy more expensive vehicles than non-prime consumers, but the results in the previous slides suggest that non-prime consumers have a stronger preference for brand prestige, or in other words, a stronger willingness to pay for prestige. And because brand prestige is often reflected in the vehicle price, and so this higher willingness to pay for prestige by non-prime consumers would drive up their purchases of expensive vehicles. But of course, how do we know that this extra preferences for prestige is driven by a desire for conspicuous consumption, right? What if the prestige simply reflect qualities that we can't see? To test that, we present two mechanisms of conspicuous consumption and derive a few predictions, which we test in the data. The first one is status signaling. Assume that consumers care about how society perceives their income relative to their peers or reference group. In other words, they care about their social status relative to their friends or neighbors, if you will. The twist is that the society cannot directly see people's income, right? Instead, they see the prestige level of your vehicle. And they also see the income distribution of your tag group, for example, your friends or your neighbors. Since people know higher income people tend to have more prestigious vehicles, the visible prestige level of your vehicle serves as a signal of people's perception of your income. And if you build a simple signaling model, that model would predict that the reputation return of increasing your spending on prestige is going to be higher if your comparison group's income is lower. In other words, the cost of showing off is lower if your peers are poorer, and thus you might be more motivated to show off if your peer or your neighbors have lower income. And so that is the first prediction, right? Like if status signaling is true, then we should see that in the data. And the second prediction is that the model would predict that if your tagged group has higher income inequality, your reputation return of prestige would also be higher. Imagine that if everybody in your tag group has the same income, then your vehicle prestige contain no information, right? Because people already know your income more or less, and they would just attribute the prestige to your preference. Oh, this person just likes to buy expensive cars. Only when there is income inequality within your tag group does prestige start to serve as an efficient signal of your income. So the second prediction of the model is that we should see people want more prestige if there is higher income inequality in their neighborhood. So to test these predictions, we enhance the regression model to interact the regressors with various neighborhood characteristics. So do we see stronger preferences for prestige among consumers living in lower income neighborhood and neighborhood with higher income inequality? So I'll just tell you what we find. So, if you look at, if you look at, column 4, you can see that indeed the predictions are valid. Non-prime consumers' preference for prestige is higher among those living in lower income neighborhood, and higher in also for neighborhood that have very high Gini coefficient. So these results support the status signaling hypothesis. Alternatively, conspicuous consumption could also be driven by peer emulation. So you see your neighbor's visible display of luxury goods, that makes you also want to buy the same thing. This scenario is captured by the expression keeping up with the Joneses. So under this hypothesis, the demand for prestige is a function of your peers' consumption of prestige. So one way to test that in our context is to see if non-prime consumers have a stronger preference for prestige if their prime neighbors display a higher level of vehicle prestige in their vehicle purchases. So here, again, we go back to the same regression, but here we interact our regressors with the average luxury content of vehicles purchased by non-prime consumers' prime neighbors. And you can see that here, the coefficient of the interaction term is positive with or without controlling for neighborhood characteristics. So this tells you that comparing two otherwise similar neighborhood, non-prime consumers have stronger preferences for prestige in neighborhood where their prime neighbors buy more prestigious vehicles. So overall, you can see that the results suggest that both status signaling and peer emulation drive the disproportionate demand for prestige exhibited by non-prime consumers. So that's sort of the basic the result. So of course, some might say, so what? Non-prime consumers pursue prestige, right? Like at the end of the day, we want people to buy what they want. But does buying pricey cars have long-term consequences, particularly for non-prime consumers? And to answer that, lastly, we switched gear and used the New York Fed consumer credit panel data to study the impact of larger auto loan borrowings on non-prime consumers' financial outcomes. So here it's an even simpler regression model. So we use this model to study the impact of the size of the initial loan balance on various outcomes. And so essentially in this equation, we want to know what this beta 1 is in the data. So it's really simple regression. So first we look at delinquency. We first look at whether larger auto loan affects delinquency, and it does. And what's really striking is that while the loan size effect is really small for people with the prime consumers, the prime borrowers, the effect is much larger for non-prime borrowers, and in particular for subprime borrowers. And if you compare them, it's almost 30 times as big. So it really means that large auto loan, possibly borrowed beyond means, does have costly consequences, particularly for non-prime borrowers. And we also look at repossessions, and you see basically the same pattern. The loan size raises repossessions, particularly for non-prime consumers. And we also looked at the impact of large loans on credit scores. And the impact is actually positive for prime consumers, but is negative for non-prime consumers. And the average effect is somewhat small here because the delinquency or repossession usually occurs, in a relatively small fraction of the borrowers. So that might explain why this is small. But of course, some people would argue that instead of genuine financial distress, larger auto loan may impact loan performance and credit scores because of borrower strategic action. Right? If non-prime consumers get very large loans, they're likely to only be liable for a smaller fraction of the loan if they choose to default, and so they may be more motivated to go delinquent or default on the loan if the loan size is so big. So this has been argued in some previous papers, but we want to see whether larger loans lead to adverse performance entirely due to that, or also partly due to genuine financial distress. So how do we do that? So lastly, we looked at the impact of loan sizes on other accounts that consumers have, not just on auto loan accounts themselves, right? We look at other accounts like mortgages and credit cards. And we found that there is an impact there as well. And the effect is particularly larger for non-prime consumers. And this spillover effect tells us that large auto loans probably induce some financial distress for non-prime consumers, and that might be part of the reasons why we're seeing the effect that we showed in the last few slides. So in conclusion, what do we do in the paper? We use a unique vehicle purchase data, auto count data to analyze conspicuous consumption motive behind non-prime consumers' vehicle buying choices, and basically we find that non-prime consumers' demand for expensive vehicles is partially driven up by their relative preference for a prestigious brand. And you can really see that there is evidence for both status signaling mechanism and peer emulation mechanism, or keeping up with the Joneses mechanism. And finally, we examined, okay, so what's the consequences of that? And we look at the impact of larger borrowings on auto loans by non-prime consumers. What's the impact on average on their loan performance? So that is all I have. I'd really look forward to some great questions. So
Excellent. Appreciate that. We have had a few questions come in. So let me start with this one. What are some examples of luxury cars in your sample? Can you give us some examples of that?
Oh, actually, I can. Here. Maybe it's too small, but like it's not in a particular order. So here I'm showing you the brand luxury share. So so you can see, like, Porsche, BMW, Audi, cars like that. And if you look at the bottom where there's zero luxury share, it's pretty intuitive. And we have an alternative measure as well. So I think here I'm using segment. So basically, models that are categorized as luxury, upscale, or premium. I categorize that as luxury, but in another definition, we basically categorize a model as luxury if the model's new vehicle's average price is greater than $30,000, and we find very similar results. It goes through all of our results, so I think it's not sensitive. The results are not sensitive to how we define luxury share.
Okay, thanks. Let's try this question. This question talks about equating low income with non-prime, and how you're describing the populations. Is that intentional? Do you have data that shows a correlation between those two terms?
Yeah, that's a really good question. So we are also struggling with this, right? Like, presumably you want to see the income of all the, of everybody who purchased the car, because the mechanism is really about income. But I don't know if I could do this, but there are people who documented the correlation between prime status and income, and there is it's not entirely, correlation is not one, but it's a pretty high correlation. People with higher, basically prime consumers have higher income. And we also, we also look at neighborhood, even though we cannot see consumers their own income level. If you recall, we can see where they live, right? Like, so even among non-prime consumers, we can see that the demand for prestige is very different. If they live in different neighborhood. But that is a tricky thing to deal with, simply because we don't observe people's income. So I guess in some sense, the prime status for this paper, just for the purpose of this paper, is sort of also as a proxy for income.
Yeah, I mean, as far as data that we see from banks that we supervise, I mean, it's not a one-for-one, but generally lower scores are equated to lower income. But as you said, it's always hard to get your wrap around that. And then there's this issue of individual income versus household income that sometimes skews that correlation. We got time for one or two more. let's see if I can even understand this question. You may have to help me with this one. You may have a confound with constraints in access to housing. If there is discrimination in real estate markets, consumption will be pushed from housing to other durables. Worse, housing had better cars. Detroit was a case in point. So I'm not sure if I really understand the question there, but
Right.
I think you might be able to address there.
I'm not entirely sure. I mean, yeah, I'm not 100% sure about what the question.
Gotcha.
Sorry.
No worries. Now I thought I'd just read it because I couldn't understand it myself. Sorry about that. My bad. Does AutoCount have data on car leases or cash purchases? Rich consumers are more likely to buy in cash. Also, leases may be a cheaper way to buy prestige than buying a whole car, and you can upgrade over time. Although I will,
Yeah.
before you answer that, I would add that in this morning's session, the people from Experian were showing that actually leases as a total in the industry are going down. But certainly, I think the question is appropriate. But do you know if AutoCount has data on car leases or cash purchases?
I mean, my co-author knows a little bit more about these details. I know that cash purchases are not in the auto count data, but I'm not sure about the leases. But I think it's not in there, leases. But the thing is that here, you know, we're really using this data to try to understand like certain mechanism, which is conspicuous consumption. So of course, it would be a really big threat if somehow people who lease cars are really disproportionately driven by conspicuous consumption motives, and that could be true. I don't know. And so we definitely should look at, you know, if there are other data sets that have leases in them, we should test to see if this mechanism is particularly pronounced among the people who lease cars, or but if we don't find that evidence, I think, you know, not having lease data in there per se is not necessarily a problem. The only problem is potential bias that not including them would produce in the results. But
All right.
something
Well,
we can look at.
sure. Yeah, and I know we're constantly looking for additional sources of data. So I'll just put a pitch out there if anybody is aware of lease data. I've struggled with that for the 30 years I've been in the industry, so I would be helpful for us. All right. Well, thank you for that that presentation. I think you pointed out certainly some interesting issues we can take away as far as, you know, who buys what are they buying, especially in light of what we heard from this morning, that the price of vehicles, the term amounts or price of vehicles are increasing significantly, term amounts are getting longer, and just affordability in general will become more of a challenge. And will that drive purchase patterns of the going? We've already seen some of that with lower subprime, as some of the speakers pointed out this morning. So this may be either a permanent or a temporary change in what we see in the industry's buying patterns. All right, our next speaker, Russ Walsh. Rush works at Ally. He's got a very interesting topic that has been in a lot of people's minds, which is just values of vehicles. I was telling some folks a little earlier, I said, certainly it's something we worry about is the explosion. What goes up may come down a little bit faster, but to date, some of the folks we've been having discussions with seem to think this is not a short-term issue. So we're very interested in hearing Russ's comments on that. Russ is Executive Director of Business and Process Optimization for Ally's Auto Business. He was in this role since 2019. He is responsible for remarketing operations and pricing, lease residual setting, contract pricing, loss forecasting, and operations optimization. With that, I'd turn it over to Russ and look forward to his comments.
Thanks, Rick, and thanks for having Ally here to present today. What I thought I'd do is maybe give you a view from the lender or lessor standpoint here on residual values and used car values and why it's important to us and how we go about it. As you may or not know, at Ally, we generate between $4 and $5 billion of leases a year, about $10 billion on the balance sheet, and remarket about 200,000 off-lease and repossessed vehicles in any given year. So it's something that's very important to us and something that we take pretty seriously. And maybe just a little bit of a background on kind of what we do. So about 10 years ago, we realized it would be in our best interest to form kind of our own residual setting team. So we went out into the market and we looked for some individuals with strong, statistical, mathematical, and really economical backgrounds to really help us build a model to help forecast used car values out into the future. We also realized that just having folks that can do the math really well didn't get the whole process, so we kind of married them up with folks that, for lack of a better term, are car folks, and really that way we got the art to go with the science of it. And when we evaluate vehicles, we not only run it through the model, but we also put it through that qualitative test, and that can impact a vehicle in a positive or negative way from a valuation standpoint. So we set this team up about 10 years ago. We basically inundated them with a ton of different data, not only internal data, but external data, auto industry data, macroeconomic data, and built out the model. And when we built out the model, we built it out not only, a lot of our leases today are from Stellantis, but we built the model out to look at the entire industry. So it's encompassing of all OEMs, and really allows us to have that data to look at additional opportunities, as also from a retail standpoint, we lend across all OEMs. So it allows us to look at the entire universe of used cars and really build that up. And we think we're pretty good at it. We think we're slightly more accurate than our closest competitors, and we're really leveraging this to run the leasing business here at Ally. So all of that data goes into what we call the Ally Used Car Index. It evaluates sales from it takes in sales from physical auctions on all vehicles. Uses over, it has over 85 million transactions in it as of today, and it's really geared a little bit differently than some of the others for us, in that it's geared to vehicles that are 2 to 4 years old, and that's really what's driving the data, and that's important because that's really the average age of an off-lease vehicle, as well as on the retail side when some of those vehicles come back to remarketing. So we're leveraging that data to really build out the forecast and to evaluate on those 2 to 4 year old vehicles. We continuously update the model. It's on its 3rd generation right now, and it's under constant evaluation. And COVID is definitely, and as I'll talk about in a few minutes, some of the things that we've seen over the last 12 to 15 months have made us revisit and really look at some of those things as we go forward. Before I kind of talk about some of the drivers that go into the model and how we do it, I thought I'd do a little bit on where used car values are. I know you saw a lot of this earlier with Melinda and Patrick, and to preface this slide and the next two, this is through the first quarter. So if I took this chart and I took it out through the second quarter, you'd see that line continue to go up through June. As Patrick mentioned earlier, I do think it started to flatten here in July, and we may have reached an inflection point. We'll talk about that in a minute or two. But obviously, values are very strong. If you look back across time, so this goes back to 2006. Values today are almost 20 points or 20% higher than they've ever been over the last 15 years, which tells you how robust the market is. And why is it like that? You have almost the perfect combination of consumer demand and low supply. So consumer demand, coming out of COVID, fueled by some of the stimulus, some of the consumer savings patterns, just having more cash on hand. And then, as we talked about earlier, some of the supply issues, and I'll dig into that a little bit more, but not only fewer new cars out on the market, but fewer cars coming back into auction, the combination of those things has really fueled the used car market to where it is today. And as mentioned earlier, I think I kind of share the view too that Values will remain elevated, I think, for a while. I think they'll come down slowly over time. I don't think there's a steep drop off. It's just they're gonna remain elevated and above pre-COVID levels for quite a while. When you look at it, that was in total. When you look at it by different vehicle types, you can see on this chart, and there's a lot of lines on this chart, but I think that the big thing here is, almost every vehicle here is at its all-time high as far as the Ally Index goes. So you can say a rising tide lifts all ships. All these vehicles are performing at their peaks over the last 15 years or so, and some slightly better than others. Things like trucks, CUVs, actually, small cars, sedans are performing very well also. But in total, everyone's up across all the segment, and the same goes across all regions. So Ally breaks its business down into 4 regions. You can see that all of them are at highs as well. You get to see a little bit of a increase over the others in terms of the South, Northeast, and Central. Those are your kind of prime leasing areas, and so those are a little bit higher than the Pacific West and the kind of the West. But in all regions are performing at peak values. So going back into the Ally Index and what's driving it. So the model has historically focused on demand-driven drivers, and 3 of the biggest ones are GDP, unemployment, and gas prices. The model had contemplates supply as well, although supply historically had been viewed in terms of overall new sales and how much was retail versus how much was fleet and lease. And we'll talk about that in a little bit more as well. But the past 15 months have really shown that there are other extraneous factors that obviously need to be taken into account. And if we've learned anything over the last 15 months, is you need to be able to pivot and adapt and to react quickly as changes are coming. So looking at some of those drivers of the demand side, so GDP is a big one. GDP has a positive correlation, as you might expect, to used car values. The higher GDP is, the higher, and generally the higher used car values are. We did see that go against in the back half of 2020 as GDP came down, but used car values came up. And really what we're seeing there, as customers were receiving stimulus payments or had adjusted their spending patterns to, maybe step away from travel and entertainment type expenses and had more savings on hand, that offset the lower GDP and really helped drive up the used car values during the back half of last year. Now fast forward to this year, GDP started to rebound. Consumers still in very good shape, and there's still lots of cash out there, so it's having kind of a compounding impact on used car values from a GDP standpoint. So this is one of the main ones we look at. Usually and historically, they kind of move in lockstep. On the flip side, unemployment usually has an inverse correlation with used car values. The higher unemployment is, the lower used car values are. And again, that kind of got turned upside down during the initial phases of COVID. I think in the second quarter last year, you did see obviously used car values come down as unemployment came down, but quickly rebounded in the back half of the year. And again, a lot of it has to do with the consumer and the financial position that they're in due to some of the extraneous factors that had come in through COVID. The last one, gas prices. This is an interesting one. If we went back to 2009, we started to see as gas prices rose, it had a negative impact on trucks and SUVs and had a positive impact on cars. And that was kind of the general thinking for a long time, that the higher gas prices were the more benefited sedans and small vehicles, and had a negative impact on more gas guzzling type cars. But I think what we've seen over time is, as gas has kind of settled in the $2 to $4 range, gas prices themselves have a smaller impact on specific vehicles and types of vehicles versus more of an impact on the consumer overall. So the more money that the consumer's spending on gas, the more it kind kind of falls with the unemployment trend, and it reduces the consumer ability to have savings and cash on hand to buy those used vehicles. So it's not so much a vehicle issue these days. It's more of just an overall market impact, and the higher gas prices are the negative impact on used car values, and the lower there's a positive. So those are kind of the biggest demand drivers we've seen. Like I said, you know, some of the actions that happened during COVID have kind of thrown some of them for a loop, but something that we continue to monitor and we think is going to be important as things, you know, stabilize going forward. The one that's kind of been the most interesting to see over the last year or so is supply. And again, you probably would expect as used car supply goes up, values go down, and inverse, lower supply, higher values. And you can see that that trend has kind of played out over time, and really, you know, helped drive the forecast. Now, again, this is used cars coming back through physical auctions, so it's not the total used car supply, but it's vehicles being sold at the auction, and that is what we're measuring on a weekly basis. So when you think about the used car supply and where does it come from, there's really three places that that are driving vehicles moving through the physical auctions: retail, lease, and fleet sales, right? And that's kind of how you think about the overall new vehicle SAR and how vehicles are sold into the market. And if you think about the life cycle of each one of those types of vehicles, a retail vehicle sold kind of comes back into the market pretty steady over time. You get, you know, between 5 to 10% of all vehicles come back, you know, in any given year, and it takes a long time for any year's worth of new retail sales to come back into the used market. On the other hand, vehicles sold through the fleet market tend to come back much quicker, and you start to see those vehicles almost immediately come back in the first year after they're sold by a fleet. And then second and third year, even more and more come back to the point where, you know, kind of after 3 to 4 years, all those vehicles have made it back to the used market. And the same thing on lease, although the majority of leases kind of come back between 30 and 40 months, but they also tend to be very front-ended in their ability to impact the used car sales. So what we've seen over the last 12 months is, and we talked about this earlier, is not only are overall new car sales down, but that mix has dramatically changed. Leases come down a bit from kind of historically in the, you know, the high 20s to 30% to kind of the mid 20s, and then fleet has come way down from kind of the high teens to, you know, anywhere between 5 to 10% in any given month. And so those dynamics are really impacting the vehicles that are coming back into the used car market. On top of that, with values where they are right now, even when leases are maturing, the lessees are more inclined to buy those vehicles today, whether it's because of the value of them versus when they originally took on the lease, or because they can then buy that vehicle, or they don't have a new vehicle to buy into. So you have less leases coming back and from the consumer, and then the dealers are scooping up more as they come back as well. So both of those, you know, not only are we having a overall gross number of new sales come back or come down, we are having a mix issue where not enough vehicles are going to come back in the short term, and then as those leases are maturing, not as many are making it to the auctions as well. And this you'll see in a little bit is going to persist for a little bit of time, which is why I think that used car values will likely remain elevated for, you know, a couple of years here, and you're going to see a gradual shift down versus a drop off. This page here kind of looks at the physical auction sales mix, kind of as I was mentioning before. You know, historically, the number of vehicles sold by dealers at the auctions was pretty equal to the number coming through fleet and lease, but with the things I just mentioned before, you can see how that those two have separated, with dealer-owned vehicles becoming a much bigger piece of the pie. And by the way, just in general, auction sales are down about 20 to 25% versus not only 2020, but also 2019, which is probably a more normalized comparable period. So not only are you seeing the gross units down, but also the mix coming through. We talked earlier about new car sales, and again, kind of in line with what Patrick said, I think that new car sales could be down anywhere between 1 and 2 million units this year. They will, start to come back in 2022 and 2023, but it's going to take some time, and it's going to take time to get back to their pre-COVID levels. So, what do we think about the used car supply long term? So, the chart on the left, this kind of looks at where we were pre-COVID and where we are now. The green lines, the pre-COVID, the dotted gray line is where we think we're going to be now. You can see that, we're anywhere from 1 to 2 million units below where we thought we'd be, 18 months ago, and that's going to continue to create supply issues in the used market. And you can see on the right how the fleet and the lease are really driving it. And to really get us back to a point where there is enough supply in the market, OEMs are not only going to have to produce enough vehicles to meet the inherent built-up demand of the consumer, they're going to have to produce enough vehicles to start to really populate dealer lots. Today, I think, when the next wave of vehicles comes through, a lot of those vehicles are already spoken for. They're going to hit the dealer lot, and they're going to just leave in a couple of days because customers have already ordered them or purchased them. So the OEMs are going to have to build through that, start to build so they can add vehicles to dealer lots. And then from there, they're going to need to build so that they can sell to the fleets and the rental car companies. And when they do that, that's when we'll start to see the supply really start to balance out and normalize, which is why it's going to take a couple of years for us to get back there, and which is why used car value should remain pretty strong, for the foreseeable future. So financially, what does all this mean on top of just having fewer used cars supply out in the market? From a lender perspective, having higher used car values is driving incremental off-lease gains and remarketing gains. It's seen a lot of lenders adjust their depreciation expense because they're trying to align the depreciation cost with the life of the lease and try not to have those big gains at the end. So you're seeing a lot of banks and lessors reduce depreciation. It's having a benefit on the credit side. Now, the majority of credit is driven from the frequency side, but when vehicles are getting repossessed, you're having lower severity. And then it's also having the impact on residual values. It's driving up residual values because we know in 2 to 3 years, there's still going to be that supply shortage and that vehicles will be worth more. From the consumer side, it's benefited the consumer in a few ways. One, it's enabled them to exit vehicles in a positive way before any form of collection action may be taken for some of those borrowers that may get into trouble. When they do go to repossession, it's reduced the deficiency balance on what they owe. For lessees, it's allowed them to get out of leases early and potentially avoid some payments and charges. And for new lessees in the market, it's definitely lowered monthly payments, all other things being equal. So a lot of moving pieces. Obviously, it's been a pretty crazy 12 months in the used car market. It's starting to stabilize a little bit right now, but I do think we're going to continue to see strength in the used car market. For the next couple of years, we'll see a gradual kind of tail down in values, but I do think we'll see values above pre-COVID levels for the next 2 to 3 years. With that, Rick, I'll turn it back over to you and see if there's any questions.
We actually do have a few. Thank you for that very informative presentation. Although I think I was telling you earlier, where I got my fingers crossed, my wife wrecked her car, and we hope it's not total because now is a bad time to buy a car. It sounds like so.
Yeah. You want to sell a car now, you're in great shape. If you want to buy a car now, it's not.
Well, actually, that's one of the questions that came up. We're looking for some personal advice. This didn't come from me, by the way, but so Right now, based on where values are and where you expect values to be, would you recommend a new car purchase, used car purchase, or a lease? And don't be too biased. I know you're in the leasing business. So.
Oh, we are an equal opportunity lender. We have new and used retail as well as lease, so we're happy to help out in any one of those categories. I think it really depends on the individual's personal situation and where they're, where they're at and what they're most comfortable with. People that enter into leases tend to be people that like to, get a new vehicle every 2 to 3 years. So that's kind of they're doing that to give the optionality to get in and out of that vehicle. I think from a new or used vehicle perspective, to our conversation earlier, if you want a new vehicle, if you can find what you want, I think that's great, but it's going to be hard for the next couple of months, maybe even through this year, to find the exact vehicle you're looking for. You may have a lot better success in the used market. There's a lot of really, good used cars out there. Those kind of 2 to 3 year old vehicles are, the way that manufacturing has improved over time. They're very reliable and durable vehicles that could be a nice a nice opportunity for some folks if they can find the right one.
Let's see. This question relates to residual valuation. So the question relates to that you get data weekly. Have you increased the frequency of which you update your residual valuation models, or have you kept it the same?
So we've definitely spent a lot. We definitely look at it a lot more. We tend to set residuals and have them in the market for a couple of months. It's hard to adjust residuals from a go-to-market standpoint on a weekly basis because it makes it too hard for the OEMs and the dealers to know, to react to that and put it into the market. So we evaluate it. We're constantly looking at it to see, where we are, but we're really looking at it on a 60-day, every 60-day period. And we're not only looking at ours, we compare it to our competitors to see, where we think where we're aligned, where we're not, where we think there's opportunities, where there's not, and really, that really drives some of our go-to-market strategy.
Thank you. This question relates to repossessions and impact on values. So once the moratoriums were dropped and firms were able to begin repossessions, the data doesn't show really a surge or any impact on values. Do you have any insights on how that affected the market when repossessions restarted, or not affected?
Yeah, I think a couple of things. One, I think that repossessions have been pretty low since the moratorium ended. I think a lot of that has to do with the strength of the consumer, as well as some of the deferral programs that were put into the market by the various lenders. So I think you've had fewer repossessions than you would have had historically during this period, which again has also helped bolster used car values because that's another way for vehicles to make it back into the auction market. So I think that it's had a positive impact on used car values by having fewer repossessions during that time.
I agree with you, and I would just add the firms I supervise, they saw a lot more people paying or had the ability to pay when they came out of forbearance than they had expected. So I think there was a lot of repossessions that never happened because people could pay, right?
That's exactly right. And also, if you're a customer and you think you're potentially on the verge of repossession, there's a lot more options today, right? I can go on Carvana or Vroom and put my VIN in there and see what my car's worth versus what I owe, and potentially even exit in a positive position if I need to or want to. So I think the customer has a lot more options before it gets to repossession these days.
I had the experience of working on voluntary surrenders on an exam, and that's what a couple of calls I was listening to. That's exactly what's going on. They knew the car was worth more than the loan balance, and were ready to turn it in and get a check. Last question. I think you addressed this, but maybe you can make. I know you when we were in the green room, you talked about this a little bit about your view. So the question is, I don't understand why you think used car prices will remain elevated for a couple of years once new cars get brought back into the market.
I'm sorry, you said, why do I think they'll remain elevated when new cars come back?
Right.
So I think that, so as new cars come back, so you think about that mix and what gets sold, again, retail versus lease versus fleet. And I think it's going to be first, you're going to be well into 2022 before you start to see that fleet share pick up. And then you have to think about what that means, 1 to 2 to 3 years down the road. And a lot of the things that are going to happen in 2023 and maybe even into 2024 have already been, set in motion by what happened in 2020 and will happen in 2021. So already knowing that we have fewer sales and knowing that we have a bigger mix towards retail already tells us that supply number is going to be lower as we get into 2023 and 2024. I think the bigger variable and the one that we continue to monitor because it's going to change the quickest is what happens on the demand side, because we know where supply is going to be. If demand continues to hold or stays at normal levels, that should help keep values, elevated. If for some reason demand falls off, that I think will be the bigger driver of values coming down.
Gotcha. That's a good point. All right. Well, listen, I appreciate all the questions and some great presentations. From what I've seen, we didn't lose any of the audience, so congratulations. So we kept everybody attention. So with that, Chellapan, I'm going to turn it back to you for closing comments.
Thank you, Rick. Thanks for moderating the panel. Let me get to notes. Thanks, Yichen. The title for your work could have been Keeping Up with the Joneses. It's a very interesting work. Thank you. And thanks, Russ, for the wonderful presentation on how to keep fine-tuning the residual models. This is really a key to limit the losses and improve the profitability of leases. Again, a big thank you to all. And thanks to all the presenters for today.